Welcome back to accounting. Second half of today's class, I thought we'd start with some current events. In my opinion, the course is called accounting, but what we're really working on is financial intuition. And accounting turns out to be a part of financial intuition, and in my opinion, a fairly important part of financial intuition, which is why I really enjoy teaching an accounting class. And what I thought we would talk about for a little while is just in general what's going on in our economy, and then how that relates back to accounting. The first article I wanted to bring to your attention, this is Friday's Wall Street Journal. So in Friday's Wall Street Journal, I thought we'd talk a little bit about something that led the section. Now, this is, just so you know, this is Friday, January 26th, and the lead article has to do with a guy named Greenspan. Now, who's this guy named Greenspan? Who's Alan Greenspan? Okay, the most powerful, or maybe second most powerful man in the world, depending upon your opinion of George Bush. Now, but who is he really? What does he do? What's his job? He's the chairman of the Federal Reserve. What is the Federal Reserve?
The Federal Reserve Bank?
The Federal Reserve Bank. What is the Federal Reserve Bank?
Decides interest rates, monitors the economy.
Okay, the Federal Reserve Bank is what? Is our nation's bank. Right? It's the national bank in America. The Bundesbank is the national bank in Germany. Every country has a national bank. In the United States, the national bank is the Federal Reserve. And the chairman, the big cheese of the Federal Reserve, is a guy named Alan Greenspan. Now, what Alan Greenspan said recently, which became big news, was what? What did he have to say?
It might be okay to cut taxes just a little bit.
What Alan Greenspan said was that, you know, since it's likely we're going to have a budget surplus. Now, what does a budget surplus mean? This is strictly accounting, right? What's a budget surplus? If we take a look at the income statement from the government's perspective, the revenue comes from what? Taxes. They collect taxes. That's tax revenue to the government. Then they have all kinds of costs and expenses. Right? They pay for roads, they pay salaries, pay everything else. Now, if revenue is greater than expenses, what's that called? A surplus. On the other hand, if expenses are greater than revenues, what's that called? A deficit. Now, if there is a deficit, what does the government have to do? It has to go out and borrow. Right? Now, so what has happened over the past year or so is that we have a surplus. In other words, the revenues, the cash in, so to speak, is greater than the cash out. And now the question becomes, what do you do with that surplus? Now you can think of it as, what do you do with this excess cash? That's not exactly accurate, but kind of. Right? Now, in the past, what did Alan Greenspan say we should do with this surplus? We should pay down. In other words, we should do negative borrowing. Right? We should pay off the amount we owe. That was Alan Greenspan's mantra. Right? Pay down the deficit. Do not give tax cuts. But now, right, that has changed. Now, why do you think that has changed? Pardon me?
Pork barrel politics.
Okay. Put it differently, if Gore had come to be president, do you think Alan Greenspan would be saying the same thing?
No.
I doubt it. Right? If the president didn't want tax cuts, you think Alan Greenspan would be standing out there saying, give us tax cuts? Since he works for the president? And the answer is maybe, right? Because the chairman of the Federal Reserve has been known to be a bit defiant. But probably what's happening is that Alan Greenspan is aware of the political climate, and he's aware of what George Bush wants to try to accomplish, and is trying to support the party that is in power right now, which of course is George Bush. And so what he does, and if you come back to this, so we're writing here, he now says, well, that surplus, maybe we can give some tax relief or tax cuts. And, you know, would that be good or not? And the answer is hard to tell, right? But, you know, this guy Alan Greenspan is a very, very important guy. Now, let's talk a little bit about what Alan Greenspan does. What does the Federal Reserve do? What's the primary thing the Federal Reserve does? They control the money supply. The Federal Reserve is the body that increases or decreases the amount of money that's available in the economy. Now, when the Federal Reserve increases or decreases the amount of money that's available, let's draw a very simple graph. What's the price of money? Price of money is the interest rate, right? It's the cost to borrow. So if we think about the amount of money in the economy compared to the amount of interest, we have some demand for the amount of money available. We have some supply of money that's available. Now, does the Federal Reserve control the demand for money or the supply of money?
Supply.
The answer is the Federal Reserve controls the supply of money. Who controls the demand for money? What is meant by the demand for money? And the answer is the demand for money is the amount of money that you want to keep in currency and or the amount in your checking account. So it's you, the individual consumers in the economy, the amount of cash you have available in your checking account is the amount that you hold in cash, is your demand for money, as opposed to the amount that you invested in the common stocks or you bought bonds or whatever, right? Now, that then gives us some equilibrium interest rate in the market. Call that I sub 0. Now, when the Federal Reserve increases the supply of money in the economy to some supply prime, what happens to interest rates? Interest rates go down to some new lower interest rate. Call interest rate I sub 0. Does it make sense to everybody? Now, the interest rate in question that we're talking about here is an interest rate called the Federal Funds Interest Rate. And so, what I'm about to show you is a picture of the Federal Funds Interest Rate. And this is today's paper. So if we zero in this just a little bit, this is, let's see, what does it say? Monday, January 29th. So this is today's paper, and we're looking at the Federal Funds Interest Rate. And the Federal Funds Interest Rate is this picture right here. And hopefully you can see, the year 2000 starts right here, January, February, March, So we're now in January of year 2001. So here's the question. What has the Federal Reserve been doing to the amount of money in the economy from, say, the middle of 1999? The interest rates did what? Interest rates were going up. When interest rates are going up, what's the Federal Reserve doing? Reducing the supply of money available in the economy, right? And then we had a flat period from about the middle of the year 2000 to the end of 2000, where interest rates were fairly flat, right? So the Federal Reserve was neither increasing nor decreasing the amount of money in the economy relative to the interest rate. But then all of a sudden, at the beginning of the year 2000, what's happening to interest rates? Interest rates suddenly are coming down. Why? Well, what's the Federal Reserve doing? Let's zero in on this again. If you come to the sheet, please. The Federal Reserve is increasing the amount of money available. Now, what you sometimes hear is that the Federal Reserve controls, and bring this, just leave it like it is, please, in the back, that the Federal Reserve controls the Federal Funds Interest Rate. And it turns out that's not true. The Federal Reserve can influence the amount of money available, right? And by changing the supply of money can have an impact on the Federal Funds Interest Rate. But the federal funds interest rate is a market interest rate. In fact, it's interest rate from whom to whom. What is the federal funds interest rate? Who's borrowing and who is lending in the federal funds market?
We are bank.
What's that? The federal funds market is what? Who's lending and who's borrowing?
Banks are borrowing.
Okay.
Some other businesses and people borrowing.
Banks are borrowing from other banks. Banks who need liquidity, who need cash, are borrowing from other banks. And the key point here is that the federal funds market is a market. It's a free market. So the interest rate in that market is not controlled by the Federal Reserve, influenced but not controlled. And so what's going on is that you look at the Wall Street Journal, right? And I'm showing you this thing. This is probably the most widely read financial page in the world. And the pictures that come down the left-hand side, right, are what the Wall Street Journal thinks that every individual in our economy should be paying attention to every day. So what we just talked about was why the federal funds interest rate is so important. And why is that so important? Because it gives us a pretty good idea, now to come back to the page, it gives us a pretty good idea of what the Federal Reserve is doing. And the question is always, is the Federal Reserve increasing the money supply? Or is it decreasing the money supply? Or is the money supply staying relatively constant? Well, we see all three of those scenarios in the picture that we just looked at, right? So the picture, for a while, the Federal Reserve is decreasing the interest rate in this region, and interest rates are going up. That's this region right here. Then it's keeping the amount of money fairly flat. That's when interest rates are fairly flat. And suddenly it's increasing the amount of money, and interest rates are going down, just like you would see in this picture. Does that make sense to everybody? Now, what I'm going to try to do is I'm going to try to pick a little piece of information out from the Wall Street Journal every class and just talk about, well, how does that affect what's going on? Now, how does this affect what's going on? Well, this interest rate, it turns out, affects virtually all other interest rates, which has a direct effect on what? Interest expense. Now, if you are a CFO at a company, what you're constantly thinking about is, what's it going to cost me to get cash? And this interest expense, or being able to forecast what interest rates are going to happen, where they're going to go next, right? So again, you're sitting right here, you're the CFO, what do you think is going to happen to interest rates? What's going to affect whether you borrow today or whether you borrow in 3 weeks, 6 weeks, or 6 months? And so a little bit of intuition about what's going on in the economy, are interest rates going up, are they staying flat, or are they coming down, is very important for your financial intuition because it relates directly to your financial statements through interest expense in this particular example, but also that then affects net income. Does that make sense to everybody? So that it's this financial savvy that I think is so important that we're going to try to use the Wall Street Journal to get some sense of, and then relate that back to how that might have an effect on the accounting that we are in fact basically being held responsible for in class. Questions? Okay, so much for current events for today. Now I encourage you to bring in anything from the Wall Street Journal or any other business periodical, and I will try to use it in class. So if you want to email me things that you have questions about, or now I want it to be financially / accounting related. If you want me to do it in this class, and I don't pick stocks, right? I don't manage portfolios, at least not for free. So if you want me to do that, you'd be out of luck, I guess. Okay, so on to Chapter 4. Chapter 4. So if you look in the notes, Chapter 4. What we're doing in Chapter 4 is we are going to review the accounting cycle. Now I'm going to review that again for you. If you go to the computer, please. The first step in the accounting cycle is what? We record transactions throughout the year. After we record those transactions, at the end of the year, what do? First, they are recorded in the general journal and posted to the general ledger. Now, notice the words here in red. What is the general journal and what is the general ledger? These are two books of accounting record. We haven't talked about this kind of crap in the past, right? And we'll never see them in this class as a formal part of the class. But the general journal is simply a place where we list all of the journal entries that happen all year long. So all those journal entries, the longhand journal entries that we've been creating, every one of those journal entries is listed in the general journal. Now, once it's listed in the general journal, it's then posted to the T account. Right? The idea of the T account that we use is the same idea as the general ledger. The general ledger gives you all the activity that happened in one particular account. So if you look at the general ledger for the cash account, it gives you all the cash that came in, all the cash that came out, and the balance in cash at any particular point in time. So the general ledger is simply the summary of all the transactions that affect that particular account. Now, so at the end of the year, we create an adjusted trial balance, and we'll see what that looks like in a second. Then we create our adjusting entries. And the adjusting entries are recorded where? They're recorded in the general ledger and then are posted to the general ledger. Now, in today's accounting, it's all done through computer magic, right? But in the old days, right, back in '06, when I learned how to do accounting, this stuff was physically transferred by hand at many companies. So you were doing all this stuff by hand. Those were not good days. Now, so we do the adjusted trial balance. What comes next? Next are the closing entries. What are we closing? We're closing all income statement accounts and one other account. Dividends declared. So the closing is for all income statement accounts, all revenues, all expenses, and dividends declared during the year. After we create journal entries, we create a post-closing trial balance. Now, in a post-closing trial balance, there should be virtually none of the income statement accounts. You should have no revenue accounts, no expense accounts. Lastly, financial statements are produced. So again, this is where we started the first half of the class with the general accounting cycle. And the goal is to do what? Is to create financial statements. And the process is summarize, do adjustments, close the books, and then create financial statements. Questions? Come back to me, please. Okay, in the notes, we're going to do an example. And the example starts on page 4-3, and the information is on page 4-3 and 4-4. So I'm going to take this information out of the book here so I can keep track of what's going on. Now, on page 4-3, what do we have? We have what's called a trial balance. What is a trial balance? It's simply a list of all the debits and all the credits for every account that's on the books. So this particular company has about 20 or so accounts on the books. And notice, total debits are $337.5, total credits $337.5. Accountants get a good feeling when the trial balance balances, right? Kind of warm and fuzzy all over. Yeah. A little bit like falling in love, but not quite. Now, on the next page, much safer. On the next page, page 4-4, this is a list of all of the adjustments that this company is going to make as of year end. And I'm going to have people in class, and there are people who are watching live, so I'm going to ask you to stay and not read forward past page 4-4. And we want to work through how to make these adjustments as of year end. But if we quickly push forward and we go to page 4-10 in the notes, so we're going to create adjusting entries, and then at the end of that we're going to do what? We're going to create an adjusted trial balance. And an adjusted trial balance is what? It's simply a listing of all the accounts that are on the books at that point, after the adjusting entries. And so there should be a few more accounts on the books, because things like depreciation expense might not have been on the trial balance, but would be on the adjusted trial balance. On page 411, these are the closing entries. So the closing entries are closing out all revenue accounts, all expense accounts, and dividends declared. We go to page 12. Page 12 is the post-closing trial balance. Notice there's far fewer accounts listed. Why was that again? Because all the income statement accounts are gone. They're all closed into an account called accounts receivable. Hence, the post-closing trial balance should have nothing that would appear on the income statement. See that? Retained earnings. Did I say accounts receivable?
Yes.
That's last few pages is the financial statement, the income statement and balance sheet, after we've recorded adjustments and done all this work. So that's what we're going to do for the next hour or so. Any questions before we start? All right. Back to page 4.4. Number 1 says, the correct value of prepaid insurance as of year end is determined to be $2,000. And your mission is to create an adjustment. Who wants to stand up and take the risk? Answer question number 1. No one, maybe you didn't hear me. I said, who was anxious to stand up and take the risk and answer number 1? Now, what are you looking for? We're looking for what is the adjusting entry. And I'll give you a hand in the process. How about Mike? Give that a try? Oh, okay. Well, you're going to be hard-pressed to follow what's going on here. Okay, Chris, want to take a shot?
What I'm doing really, but I'll try.
Well, maybe together we can solve.
Okay. So I'm thinking just like we usually do, we're going to adjust it in equity, tax, stuff like that.
Yes, we are.
Okay, so I'm thinking we're going to debit your...
The correct value of prepaid insurance is determined to be what's the balance before we correct it?
Oh, okay.
Okay, so where do we look to find the balance in prepaid insurance? The trial balance. And what account do you think we're going to adjust?
I think we're probably going to... We have to adjust prepaid insurance account. Okay,
so we have prepaid insurance. And the amount for the trial balance is how much?
$5,000.
$5,000. Okay. Do we have insurance expense on the trial balance?
Yes, we do. It's a retained earnings.
Okay. What's the balance on it?
$2,500.
Is it a debit or a credit?
It's a debit.
I'll put a little TB here. That's the amount for the trial balance. Okay. So now the adjustment says that the correct balance in prepaid insurance should be how much?
$2,000.
Should be $2,000. So $2,000 is the actual amount.
Right.
So what entry are you going to make?
I think you want to credit the prepaid insurance.
We credit prepaid insurance for how much?
$3,000.
$3,000.
And
that's journal entry number 1, adjusting entry number 1.
So then you're going to have to do your insurance. What is that again?
Insurance expense.
That's got to be what's it called? Debited.
Debited.
No.
We're lefting it. We're debiting it for $3,000.
So anytime we credit on the one side, we have to debit the other side.
That's correct.
Okay.
This is journal entry number 1. Does that make sense to everybody? Now, what's our best guess as to what insurance expense will be for the year? Our best guess right now is going to be $5,500. Right? And what we did was we recognized that maybe we bought insurance during the year, but we used up $3,000 of that insurance during the year. Therefore, that amount we used up would then become an expense for this period?
3,000.
Of $3,000. Then we add that to the amount that was already recognized as insurance expense, and come up with a total of $5,500 for insurance expense. Does that make sense?
What's the insurance expense?
On the trial balance?
Yes.
Okay. Chris, where's the insurance?
At the bottom there.
At the bottom, and it's going to have a debit balance. Now, next question. How did we determine that, in fact, $2,000 was a reasonable number? How did the firm do that? What's that, Terry?
When they purchased it, it wasn't a full year.
Okay. But then how did we figure out that $2,000 was left?
What's the policy number of months left in it?
Okay, well now, how many insurance policies do firms usually have? One? So let's say GE. How many insurance policies does GE have?
Many?
One? Okay. They have insurance policies coming out the wazoo, right? That's how many insurance policies they have. They have insurance policies to cover every building, every machine. They have insurance policies to cover people, right? Now, what happens at the end of the year? Some poor slob gets picked on to do an analysis of all the insurance policies. And that analysis can take how long? It can take days. Because they have to go and they're checking not only the accounting side, which is how much should be the expense, but they're also checking, do we have the correct amount of insurance? What is our risk exposure? So some poor slob has to go and review every insurance policy, find out what premiums we paid, find out what it covers. Does it cover everything that it should be covering, right? Turns out the analysis of insurance is a very detailed, very difficult process. But the end of that process is, in this example, that $2,000 is the amount that it should be the ending balance in prepaid insurance, which then gives us our adjusting entry. But you should understand that number, 2,000, is not an easy number to come up with, because that process involves not only the accounting estimates, but you evaluate all the insurances, you evaluate risk, you evaluate all kinds of issues that, in fact, are very important to the firm, culminating in our insurance expense for the year. Questions?
So the expense of the insurance for the year cost you more than the actual value of the insurance?
No.
No.
No, the $5,000 was simply the amount that you had paid for that, in fact, had not been expensed yet.
Okay.
Right? In other words, for the first half, they may have expensed a whole lot of insurance. Because they could have made up, quarterly financial statements or, semi-annual financial statements, and they recorded expense then.
So there's kind of an overlap.
In a sense.
Okay.
So you paid for 5,000. Sorry, you basically it's 5,000, but your expense was 2,500. I mean 2,500 in the beginning and before the
No.
adjustment.
The trial balance is simply the amount that was paid for that hadn't been expensed as of year end.
So 2,500 was expensed
During the year, and probably paid for. So maybe they bought a 6-month insurance policy, right? And they did that in, say, January, and they already recorded all that expense by the time year end was up. So $2,500. In addition to that, they paid another $5,000 for insurance policies, of which the value was $2,000 as of year end. Is that making sense?
Yes.
Okay. Who wants number 2? So we need an adjusting entry for property, plant, and equipment.
I would say you have to debit an equity account for your depreciation expense.
Okay. So let's first of all identify what accounts we are going to be dealing with. PP&E, right? What's the balance on PP&E on the trial balance?
40,000.
40,000. And then we have accumulated depreciation?
Yeah.
Of how much?
It's going to be 4,000.
Okay, no. What's accumulated depreciation for the trial balance?
Oh, I'm sorry. 12,000.
And what's depreciation expense this year? So far, on the trial balance.
I don't see any.
Okay, it's not there yet. Why isn't it there yet?
Because it's an adjustment.
Because it's an adjustment, right? It's not a transaction. The transaction was to buy the equipment. Now, how old is the equipment, do you think?
Less than 10 years because it still has its value.
Okay, well, let's reserve that question for a second. Okay, this year, what's your depreciation expense going to be?
It's going to be 4,000.
Okay, so it's going to be 40,000 divided by 10 years is 4,000 per year, right? So how old is the equipment, do you think?
3 years old.
Let me ask it again. How old is the equipment?
4 years.
It was 3 years as of when? As of January 1st. We're adding another year's depreciation this year, so the equipment's probably approximately 4 years old of a 10-year life. Does that make sense, everybody? Now that's why we have this separate account called accumulated depreciation. Because it gives us some sense, it gives the investor some sense of how old the equipment is. For instance, if a firm had, property, plant, and equipment, $25 million, accumulated depreciation, $24 million, net balance, $1 million, the investor looks at that and says, aha, I know how old that equipment is. Ben Franklin bought that stuff. Does that make sense, everybody? And so by showing two accounts for accumulated depreciation and property, plant, and equipment, we give the investor relatively more information. Not a lot of information, just a little bit more information. Okay.
3 or 4 years? 4?
Well, for the trial balance, it would have been 3 years old. The trial balance was as of January 1st. This year, we're going to add 1 year's depreciation. So as of the end of the year, it will be 4 years old. Right? Okay. So, now this year's depreciation expense entry would be what? To?
The depreciation expense.
Okay, depreciation expense, an equity account, debits decrease equities, credits increase it. Accumulated depreciation, what type of account is that?
It's a contra asset account.
It's a contra asset account. So depreciation expense is 4,000, which is a debit to depreciation expense. That's entry number 2. Credit to accumulated depreciation, 4. That's again entry number 2. So at the end of the year, accumulated depreciation is 16,000. What is the net balance of property, plant, and equipment at the end of the year?
$40,000.
What is the net balance of property, plant, and equipment at the end of the year?
25,000.
It'd be PP&E less its accompanying contra account. 40 minus 16 is 24,000. So the net balance of PP&E would be 24,000 as of year end. Does that make sense, everybody?
PP&E on the balance sheet will never change. It'll always be 40,000, but it'll just be accompanied with accumulated depreciation.
Yes. Yes. In a separate account. Right. Chris, question? Questions so far? Okay, item number 3. The cost of inventory on hand, December 31st, is determined to be $55,000, based on the physical count. Inventory. So, I guess the next question is, what's the answer we're trying to make here? What's the issue? What are we trying to figure out? Nate?
Our ending balance on our inventory of the trial account is going to be 55,000.
So the ending balance is 55, right? Okay, let's put that information in. So we have some beginning balance in inventory, plus purchases of some amount, and that's equal to cost of goods sold plus ending balance. Now what we just found out was that the ending balance was how much? 55,000. Now how do we find that out? Well, we haven't counted it up, right? We haven't counted it up, multiplied out by the cost per unit, and the total amounted to 55,000. Questions about that? Now, what are we trying to figure out? trying to figure out cost of goods sold. That's our question. That's our issue. But in order to get that, we have to do what? We have to figure out what was the beginning balance in inventory and what were purchases during the year, which should appear where? On the trial balance. So we have the beginning balance in inventory.
Yes. 45.
45,000. So we have purchases. Purchases are 130. Therefore, what's cost of goods sold?
120.
Maybe 120. That makes sense to everybody. Now, we did our analysis, but in accounting, everything moves based on what? Journal entries. So what journal entry do we make based on this information?
We have to have an asset account for inventory.
Okay, inventory goes from what to what?
Inventory goes from 45 to 55.
So it's an increase or decrease?
An increase
Of how much?
of 10.
10,000, right. Okay.
You have an equity account for cost of goods sold.
Okay, so we're going to recognize an equity account of cost of goods sold. So we're going to this is an asset account. We're going to recognize an equity account, a retained earnings account, right, called cost of goods sold. For how much?
120.
Okay.
And then you have to, sales would also be...
Okay, sales would be a separate transaction. Right?
Yeah.
Let me give you a clue. What type of an account is this purchases account?
It has to be also an equity account.
Well, it's actually an inventory type account, right? And so what we do is we put a separate account in the books called purchases in order to be able to keep track of the inventory we purchased during the year. And
It's also an asset account?
it's an asset account, so we take that asset account purchases off the books, reduce an asset account purchases for 130. Does that make sense to everybody? Now again, why did we have this account called purchases on the books?
We can figure out the cost of goods sold.
Because Boylan likes to use boxes. Right? So Boylan could use his famous box approach. I created an account on the books called purchases. It's an inventory type account. And that inventory type account, they purchased 130 during the year. Now, as of the end of the year, we're going to close everything into inventory. And so we are, in essence, closing out this purchases account. Now, we're not closing it out as part of our closing entries at the end of the year. We're closing it out as part of our, which is the process by which we recognize cost of goods sold.
So you also consider it asset?
Well, it actually is just an asset account, right? It's an inventory type account called purchases. Chris?
So, does cost of goods sold is some account also now?
Oh, cost of goods sold is now on the books.
So we had purchases and cost of goods sold.
No, purchases was on the books.
It was already there on the trial
Well,
balance.
check the trial
I
balance,
think you're right.
right?
Okay.
We took that off the book. Now, remember we talked about inventory before. Firms either use the perpetual method or the periodic method for recognizing inventory. Which method does this firm use?
Periodic.
It uses the periodic method. Why?
They did a physical count.
Well, every firm, no matter how they do inventory, does a physical count of inventory at the end of the year. So that wouldn't tell you. Right? Cost of goods sold did not appear on the trial balance. Now, if they were using the perpetual method, what would have to happen? They'd be recording cost of goods sold every time they made a transaction, right? With the periodic method, they wait till the end of the year and they periodically recognize cost of goods sold. Questions?
I have a question on the trial balance. Purchases is listed down in the equity area. Is that because it gets closed out? Not listed up above the asset?
It could be listed anywhere. I just happened to be where it got stuck. I mean, technically it should be an asset account, and could easily be listed with the assets. So it doesn't really matter where it's listed. Questions about that? Okay, this is journal entry number 3. Now, if you notice, these journal entries are a little bit more difficult than anything else we've done so far in this class. Because what this is forcing you to do, usually what we did in the past was I gave you some example with 3 numbers in it. And anyone with any sense at all knew, well, I take those 3 numbers, I either add them or I subtract them or I multiply them. But I got to do something with those 3 numbers to get the answer. What we're doing right now requires financial intuition. So you need to think about what accounts are being affected by these adjusting entries. So we're trying to move from simply recording information, which basically is what we've been doing all along, to using financial information by understanding how things are related to each other. So the goal of this chapter is to get you thinking about not only how to record the information, but how to use the information. And what that means is you need to know what accounts are related to what other accounts. For instance, knowing that property, plant, and equipment, and accumulated depreciation, and depreciation expense were all linked together to give you information about the firm is the point of what we're doing in this particular chapter. Questions? Okay, next. Number 4. Who'd like number 4? Unearned commissions are determined to be $1,000. Unearned commissions. What's up, Bill? Want to take that one? Now, I don't want to make you nervous, but it's probably the most difficult one there.
Well, got a credit for unearned commissions.
First of all, Bill, let's go to the trial. Let's go to trial balance. Do we have unearned commissions on the trial balance?
We do.
Okay. What's the trial balance amount?
I think this is 4,000 if I'm reading that across straight.
Yeah. Okay. Debit or credit balance?
Credit.
So the credit balance of $4,000 for trial balance. Okay, that's a good start. Now, unearned commissions can be related to what other account do you think? So anytime we're making an adjustment entry, we need at least 2 accounts. Good question, he says. Let's go back to unearned commission. What type of an account is unearned commission? It has a credit balance of $4,000, right?
Right.
What type of an account is that?
The equity. Asset.
It's a liability account.
That's alright.
So the question is, why is that a lie? How did the amount get into this account? What kind of commissions are we talking about here?
Commission services.
Wages that were supposed to be paid and weren't paid.
Okay. That's what makes this thing so tricky, right? Because commissions, it's not clear whether we're receiving commissions or whether we're paying commissions. Right? And so the first thing we need to think about is, this commission stuff, are we earning the commission? Is that one of the services we provide? Or are we paying our salesmen, say, commission on their sales? Is that how commissions come about? And in this case, commissions are going to be what? The commissions that are earned. So we're providing a service to some other company, and they in fact are paying us a commission on the service that we provided. Does that make sense, everybody? So the entry here, what entry did they make to get $4,000 into this liability account? What did they get? They got paid up front. So the entry they made was an increase in asset called cash.
Who got paid in front?
The firm in question, of which we're looking at the trial balance, right?
We got paid up front.
We got paid up front. That's the firm. That's us. We. That's exactly right. And the amount for $4,000. But had they provided the service at that point? And the answer is no. Hence they recorded what? A liability called unearned commissions for $4,000. Does that make sense, everybody?
To balance out a message of $4,000.
Right. They got the cash. They had not provided the service, therefore it was not revenue. Right? And they didn't recognize the revenue until they went back and looked at what services did we provide during the year. Now, Bill, we come back to you, and we see that the trial balance amount was $4,000.
Right.
But number 4 says that as of the end of the year, unearned commission should be how much?
1,000.
1,000. That's the new ending balance. Now, what account is going to be affected by that?
Your commissions earned, so that would be your retained earnings.
The retained earnings account called commissions earned. Okay, look in the trial balance. What's the balance of commissions earned?
1,500.
Credit balance of 1,500. This is the trial balance amount. So what's your entry going to be, Bill?
So an ending balance is 1,000.
Right? Unearned commissions gets left. Is that what we said?
What's that?
Go ahead. I'm putting words in your mouth here. In order to go from 4,000 to 1,000, what do we have to do? Subtract 3,000. So we debit unearned commissions for 3,000, right? So entry number 4. And what do we credit?
Commissions earned.
Commissions earned. So all we did was we recognized the fact that once we provide the service, we recognize the revenue, right? And we provided $3,000 worth of service, therefore we're going to recognize $3,000 worth of revenue.
Okay.
So then total, our estimate right now for total commissions earned as of year end will be how much?
4,500.
The 1,500 they already recognized plus an extra 3,000. Kelsey?
How come that account is commission earned and not a commission expense?
Well, again, it's commission revenue. Because we're providing the service to some other company, and they're paying us for providing a service.
It's an equity.
You could call that sales. But that was their primary revenue generation. It could be simply sales. Commission revenue, perhaps. Right? Kelsey, does that make sense? Okay. Yes, Dave.
The unearned commissions in the trial balance, which is $4,000, is that as of the beginning of the year?
Yes.
And
No, that's the trial balance.
As of the trial balance.
Right.
Oh, okay.
Right. So this is something that happened during the year, and now we're making adjustments. So we've gotten the cash during the year, but they had not provided service until they go back and adjust it. Kelsey?
Back to your previous question about if we pay our salespeople commission, then would that be a
That would be a very
commission
different, that would be an expense, that's right. That's right, but that's not this example.
expense? Right.
But eventually you still haven't closed the account of commissions earned.
Not until the closing process. That's exactly right. At this point, it simply is the amount that would appear on the adjusted trial balance. Right? Number 5. Who would like number 5? Beth Ellis, fix number 5. I'll give you a hand, okay? Wages owed to employees for service they provided during the year, but for which they had not yet been compensated, was determined to be $600. None of these wages apply to factory workers, factory employees. So what are we doing at the end of the year, Dels?
You're adjusting the wages that have been
Okay, so
paid.
what's going on is, during the year, we recognize a certain amount of wages. And then, if we look at the trial balance, how much was that?
40,000.
40,000. And then what happened is at the end of the year, these people worked, but they didn't get paid until when? The next year. And the amount is $600. But for what entry are you going to make for that $600?
You're going to decrease an asset, which is wages.
Okay, it's an equity account, right? You're going to recognize wage expense.
Oh, wage expense.
Decrease, debit, decrease in equity account, wage expense. Now, we're going to add 600 to the 40,000 already on the books, right? For $600. You're going to credit what? We're going to recognize that we owe them the money. When we owe them the money, it's a liability. We want to call it liability.
Wages owed.
Wages owed, wages payable. 600. Chris?
General question. So, do we have to call it wages payable, or can we call it wages owed? Is there some type of standard we have to follow?
Well, I don't care what you call it, as long as you know what it is.
Okay.
Right? But the convention we're trying to use in this class is any liability account we call what? Blah, 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 payable. Any expense account we call what? Blah, 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 expense. Just so it gives us a clue so we know what type of account it always is. Kelsey? You look unhappy, Kelsey.
That's it.
You okay?
Yes.
You did great. Now, one last question on number 5. It says here, none of these wages apply to factory workers. Now, why is that important? There's a little weasel in there.
Are they hourly?
What's that?
Are they hourly?
No, these are employees that do marketing and administrative work, as opposed to the factory workers.
Because it would be labor that would have to go into the cost of goods sold.
Exactly. If these laborers, if this wage was paid to factory workers, remember we have to capitalize that cost as part of work in process. It would suddenly become part of inventory. It wouldn't become an expense until we sold the goods, right? Because of the whole work in process thing we talked about, which will be covered in much greater detail toward the end of the class.
Can you explain that again? The last part.
Work in progress.
For work in process, or work in progress, same thing, right? What happens is, also called WIP, right, WIP, this is an inventory account. What goes into work in process? And the answer is direct materials, direct labor, and overhead, right? And so, if these laborers were part of the factory workers, then the cost of their salary would not become an expense right away. It would get capitalized into this inventory account called work in process, would then get moved to finished goods. And then, lastly, the cost of goods sold when in fact it was sold. And wouldn't become an expense until it became part of cost of goods sold. Does that make sense to everybody?
So instead of debiting an equity account, expense would be
There'll be an asset called the work in process.
Work in process.
That's exactly right.
What's the intermediate step there? What's that, G?
Finished goods. I think this is the general flow through the accounts. But in this case, we recognize the expense immediately because it's not part of cost of goods sold. Questions? Number 6. Isn't this fun? Don't you just love accounting? Starting to figure out what's going on here? A little bit. But there's a lot to know. That's exactly right. And that hopefully is what's being impressed upon you as we do this. That the key to understanding what's going on is to understand how accounts relate to each other. And, the next account, note payable, you have to know what to do with it, how to calculate it, and what entry to make because of it. You have to know all the associated accounts that affect this particular account. Okay. Number 6, note payable is a 1-year note dated March 1st, 2000. Interest at the rate of 12% per year, and you can thank me for that wonderful number, 12% later. Okay? And it's payable on February 28th, year 2001. So what's your mission on this particular adjusting entry? What do you have to do?
Determine the interest expense.
You have to recognize interest expense. Right? So Dave, what's the interest going to be?
You're going to... First you have to figure out exactly what the interest is that you're going to be charged. So it's 3/4 of the year at 12%, so you're essentially paying 9% of the note that you purchased.
Careful.
February 20th.
March 1st, right? You have to include March.
Okay.
So you'd have 10 12s. Okay. So it would be 10 12s times the annual rate of 12% times
the note payable, which is...
So go to the trial balance, get the note payable, which is...
14,000. Reading that across right.
What number did you get?
14,000.
14,000? Everybody agree? So this would be 10% times 14,000 or 1,400. So what's your entry?
So you're debiting equity.
Decrease in equity account, a retained earnings account called what?
Interest expense.
For?
$1,400.
And crediting a?
Liability interest payable.
For?
$1,400.
So we're recognizing that we owe them the money. It's a liability account, interest payable. And we're recognizing that we in fact have incurred an expense for the amount that we owe of $1,400. Does that make sense, everybody?
Thank you for using 12%.
My pleasure.
Now, why does it say payable on February 28, 2001?
Because they borrowed the money.
It's into the next year?
Right.
You don't have to account for a couple of months there. You're doing everything.
Well, you would account for January and February of the next year in the next year. Questions? Number 7, taxes payable. The amount of taxes we pay, we couldn't do that at this point because we need to know all of our adjustments before we can do taxes. So let's move on to number 8. Number 8, note receivable. Who wants number 8? Go ahead, Craig. Number 8, for us, please.
Okay. Your note receivable is for $9,000. And that's an asset. It's an account receivable.
A note receivable, right? It's $9,000.
Okay. So
it's a 1-year note dated July 1st. Interest at a rate of 10%. And it's payable on June 30th. Now, note receivable, what did we do on that note receivable? What was the entry we made to get that note receivable on our books?
Minus cash.
Right, so we would have debited an account called note receivable for $9,000, and we would have reduced an asset called cash. We made a loan to somebody, right? Is all we did. And therefore they owe us back the money. It's a note receivable to us. Okay. So are we going to recognize expense or revenue in this case, Craig?
Revenue.
We're recognize revenue. That's going to be 9,000 times what?
10%.
Times the 10% per year times the amount of the year, which is
6 months.
6/12. Okay. So 5% of 9,000 is 450. What's your entry going to be?
Okay. It's revenue. Yeah, interest earned.
Interest earned, interest revenue. We credit for 450, right?
Okay.
What's the other half of that entry? We could call it a note receivable, right? As part of the note, or we could separate it out into a separate receivable called interest receivable.
Okay.
For $450. But in any case, it's an asset to us, right? It's something we're going to receive in the future. And the amount we're going to receive is the $450. Questions? Y'all are looking a little low on energy right now. Is everybody with us? Number 9. Number 9. Number 9. Number 9. Y'all are too young to know that. Okay, now, number 9. During the year 2000, the company established customer defaults, or estimated customer defaults, to be 0.5% of sales. A review of the amount outstanding suggested that the allowance for uncollectible accounts should be $1,400. So what entry do we have to make here? Becomes the next question. Well, let's set this thing up. So what we have is the accounts receivable. We have an allowance account. We have bad debt expense, or estimated, what do they call it? Estimated customer defaults. So now we go to our trial balance, we start looking for some information. What's the balance in the allowance account?
$2,000.
$2,000. So the balance in the allowance account is $2,000. Now I'm going to leave a little space here because I want to ask the question, how did $2,000 get in there? We'll worry about that in a second. What was estimated customer defaults? What's our estimate for bad debt expense for the year? $1,500. What entry did they make during the year? So this is $1,500 for a trial balance. This is trial balance amount, $2,000. What entry did they make during the year to get $1,500 into estimated customer defaults? When they estimated bad debt expense, what entry did they make?
They debited equity, $1,500.
They debited the equity account, estimated customer defaults, $1,500. What did they credit? The allowance account for $1,500. Right? Now, what's our best guess as to what the beginning balance in the allowance account was as of the beginning of this year? 500, right? Now, that's not important for the answer, but it's important for financial intuition, right? We went back and we recreated what went on during the year. Now, number 9 says what? They did an analysis of accounts receivable, and they determined that what should happen? The allowance account should have a balance of how much? $1,400. So what do you have to do?
You have to debit your allowance.
You debit your allowance for $600. This is entry number 9. And do what?
And credit your estimated customer defaults.
And credit your estimated customer defaults by $600. So the new estimate for bad debt expense, new estimate for estimated customer defaults is going to be what? $900. So what we did here was we figured out that we had estimated too high. So in our adjustments, we realized we estimated too high, and we reduced our adjustment for bad debt expense. Does that make sense to everybody? Okay. What I'd like to do is I'd like to go through the last entry. We'll say closing entries for next time, because I've noticed some people here are looking a little tired, a little cranky. No one's paying any attention to what we're doing at all, near as I can tell. But I want to make it through. one more entry before we go home. Now, time for income tax. Go back and do item number 7. So income taxes is the same as income taxes, and the effective tax rate is 40%. What do we pay taxes on? We pay taxes on essentially net income, right? Net income before taxes. So how do we do that? So the last adjusting entry we make, we go back, we figure out all of our revenue accounts, all of our expense accounts, we take a look at the net amount, and we say, okay, this is the amount of income we're going to recognize before we pay taxes. And then we say, okay, given that amount of income, how much tax do we owe? Multiply by the tax rate to get income tax expense for the year. So if you go to the screen, please, the wizard's in the back. What we find is that when we add up all the revenue accounts, now what? There's commissions earned, there's sales, there's all those other revenue type accounts, interest earned, total revenue accounts were $204,550. Total expense accounts were $183,900, not including tax expense, giving us taxable income of $20,650. The tax rate, which number 7 says is 40%, multiply $20,650 by 40%, giving us income tax expense for $8,260. So, at this point we need to make a adjusting entry for tax expense as of the end of the year. Who wants to give it a shot? Just line up over here on the side here. Everyone who wants to take this and give it a shot. Okay?
Well, you would debit an equity account called income tax expense. The difference between the $4,000 that you had hoped to pay and the $8,260 that you now find yourself owing, which would be $4,260.
Okay, so Dave, what you did is you went to the trial balance and you found out what?
That we had budgeted. Well, we've already paid $4,000.
We already paid $4,000 to the government, right? So the trial balance amount is our income tax expense already has $4,000 in it. Now, why would that be the case? Because why would the government? Why would we have already paid taxes to the government? Why would we wait until the end of the year and we did our taxes?
Prepaid.
Every firm makes estimated taxes every quarter, right? So the end of the first quarter, March 31st, by April 15th, the firm is required to send an estimated amount of taxes they expect to owe to the government. So what's going on is for the first 3 quarters, this firm has been making quarterly payments to the government, and the amount of tax expense they have so far recorded is $4,000. But now at the end of the year, they did their tax calculation with the end of the year information, and they found they owe how much, Dave?
$8,260.
Therefore, they have to recognize what? Adjust the entry for how much?
$4,260.
So they debit income tax expense of $4,260. This is entry number 7. And they credit what?
Income tax payable.
Income taxes payable. $442.60. Journal entry number. That makes sense to everybody. So let's do that again. So the firm had already paid $4,000 in taxes. We did our tax calculation and we found what? That the amount that we were going to owe the government was $8,260. Therefore, we make an adjusting entry to recognize an increase in income tax expense of $4,260. But as of year end, have we paid the government the money? No. We owe them the money. And so we call it income tax payable. because we owe the government the money. Questions about that?
Income tax payable is liability. Okay.
It's a liability account, exactly right. That's what I said. Questions about that? Okay, so at the beginning of class on Monday a week, the next class, we're going to start out to a quick review of adjusting and then go into our closing entries and finish this chapter up. Any questions? Okay, let's close it off here. I can tell I'm losing you. So, make sure you review this chapter before you come back, because we're going to go through this chapter very quickly. Quick review on the closing entries. Next week, we're also going to be doing present values. Now, you'll need to bring the present value tables that appear in, there's an Excel spreadsheet where I give you present value tables. So you'll need to bring those present value tables, and it's listed as, it's listed on the website. So make sure you bring your present value notes, the present value tables, and also Chapter 13. Chapter 13 is financial statement analysis. Any questions? You have a good week. See you next Monday.